Okay, then I say welcome to Johanna Strömsten, Portfolio Manager, International Real Assets for Alecta Investment Management. Welcome.
Thank you.
How are you today?
I'm good. I'm feeling a little bit hot since it's 30 degrees here in Stockholm, but otherwise good.
Yeah. I was thinking you could start by just introducing Alecta and what you do there in your role.
Of course. So Alecta is an occupational pension fund. We have our headquarters in Stockholm, and we have been around actually since 1917. So we're a very old company nowadays. We have an AUM of 970 billion Swedish kronor. And if you look at how the split looks like between those 970 billion, about 50% is in credits, about 38% is in equities. And then we have where I work, which is the alternative part, it's about 12% nowadays. So I work as a portfolio manager within Real Assets International. We're focusing on infrastructure and real estate. But up until now, real estate has been the majority of our portfolio. Actually, today it's about those top 12% is almost all that 12%. We started off doing infrastructure about 1.5 years ago when we received a mandate from our CEO to start focusing on infrastructure as well. We have a history of being focusing on sort of listed products, and therefore we haven't done so much in the unlisted space up until just a few years ago.
So that is changing. You're going more into unlisted assets.
Correct. So we're going more into unlisted assets, and the history behind that is basically that being a listed company has its pros and cons, especially when depending on how the market develops, and we need to be a little bit more uncorrelated to the listed market, and therefore we're also focusing much more on the real asset side nowadays. And the unlisted side.
And how many are you on your team and on the team as a whole?
We are in our team where I work. We are 3 people, and I'm working sort of on what we call it the indirect part, and that is everything that is unlisted, listed equities, that is JVs, clubs, and funds. And then we have a direct part as well on the real estate side, which is most focusing on real estate, and it's actually now going through a transition where it's becoming a subsidiary to Alecta, where we're creating a real estate company, and that works about 15 people. But in total on the Alecta investment management side, we're about 40 people on sort of investments, and about 20% or so working in the more administrative parts.
Mm-hmm. And do you also outsource some of the mandates, or are you entirely taking all the decisions yourselves?
Yes, we don't outsource anything actually. So we're doing all the decisions ourselves. I know that there's a lot of consultants out there that are helping pension funds with this type of services, but we have decided to do everything in-house so that we can control. Since we're going to live with these assets for a very long time, we want to feel that we have control.
Mm-hmm. And in terms of the overall return and risk targets for your portfolio, what is that? And is that per mandate and per your specific unit, or do you have like an overall target for the whole portfolio?
We have an overall target for the whole portfolio, but we also have specific targets for the different asset classes, of course, because there's different risks associated to it. But so we have a target, but we also, of course, we have a blended target if we look into sort of core plus value add, which is the world that I'm living in real estate and infrastructure. And there we have a blended target level that we need to focus on. So not every asset that we're investing in needs to meet our targets. We just have to meet it on a blended level. But we have, as I mentioned up until now, focused much more on equities and credits. But the plan now is to grow our real assets portfolio to about 20% of the total AUM of Alecta. And when we're doing that, we're going to take part of the credit portfolio and part of the equity portfolio and sort of blend that average return targets to sort of match what we can get in the real assets world.
And what is the underlying reason for transitioning into real assets and alternatives? Is that it's becoming more difficult to actually generate the returns required from your portfolio in the traditional assets?
No, I think it's more that we felt that we need to be much more uncorrelated to the listed market and to the BNP and lower our BNP correlation overall. And then it's also that if you want to invest in infrastructure and the real estate, part of it is unlisted. So it's also a way to access these different asset classes. But the majority is to get down the correlation to BNP. To GDP, and by saying that, I think it's really important also to mention that when we look into these different asset classes, you can also have GDP-driven assets in it. I mean, I think it's one obvious case is maybe airports in infrastructure, and they can both be unlisted and listed, and it's been highly correlated to GDP. So for us, it's not only about investing in infrastructure or real estate as an asset class. It's also about finding them being uncorrelated to GDP as a sector and as a geography.
Yeah. And at the core, do you work from some sort of core model portfolio that you try to build, or how does that work? And how often do you rebalance that portfolio in that case?
I think when it comes to the real estate portfolio, where we have a large portfolio per today, we have a long-term target how we want to develop our portfolio and what sectors, geographies we want to focus on. So we're more focusing on changing the portfolio over time, as we don't do any large rebalances. But we have, before COVID-19, focused a lot on non-GDP driven strategies, and in real estate that is focusing on residentials, for example. So now when we started off building our infrastructure portfolio, we had that in mind, that we wanted to focus on much more non-GDP driven asset classes. So we have focused on what we call the super core sector, where you really own the asset itself, and you don't take so much volume and price risk, for example. But we have also, to blend those more super core assets, we have also focused on more value add characteristics, where we have some value add funds focusing on public to private, for example, which has been good when the unlisted markets have been priced very highly. And also we've been focused on much more value creation and complexity, given that the infrastructure has been so competitive and there's been so much dry powder out there. So we had to focus on finding more niche strategies, building up this portfolio. So that's sort of how we sort of build it. But given that we're starting off building our real estate and infrastructure portfolio and growing it, we're not focusing on rebalancing it so much at this point.
And you mentioned the COVID-19 situation. Have you changed anything in your portfolio given that situation, or is there anything that you've learned from that experience, that we've had now for the last 2 to 3 months, at least? How has your portfolio behaved, and have you learned anything from it?
Yes, I think we have for a few years' time now felt that the market has been very very highly priced, and we've been worried about the multiples we've seen and the yield levels in the real estate world. So we started to think that we should focus on more non-GDP driven strategies. So that's been the focus for some years now, and we can really see that benefits us during this crisis, because when we look at the valuations and rent collections and so on, it's been very, very stable compared to other more GDP-driven strategies. So I think that is something that we have done and that we learned was a successful strategy coming into COVID-19. We didn't foresee that it was going to come a pandemic, of course, but we maybe foreseen that it will happen something with the economy overall. So that's one thing. And then we had some projects that we were looking into just before COVID-19 happened, which we had to pull out of because we were so unsecure about what the value long term were going to be and how quickly it would recover and so on. So that we hadn't done. And then we have seen some opportunities also coming up during this crisis. We have seen listed companies, for example, wanting liquidity, partly because of financing reasons, but partly also because they've seen their stocks been so devaluated that selling off something in the unlisted world and then buying back their shares have been a pretty good strategy. And it's also been pretty good for us because we got a quite good discount during those transactions.
Mm. And coming back to this, your view on risk and how you measure that and how you look upon risk. Can you tell me something about that?
I think when it comes to, especially on the infrastructure side, where you really sort of have this core plus value add different strategies, I think at least when I entered this space, I know that someone told me that you really have to look out for what is actually core plus and what is value add, because there's a lot of infrastructure managers that gone from sort of core to now going to value add, and it's you can go the other way from value add to core, but it's really difficult to go to core to value add because there's so much different characteristics and complexity, and you need to have another skill set and also another type of promote structure to incentivize people. So we've been very sort of focused on finding managers where we really feel that the core risk is also core returns. We had some managers that we were close to investing in the core space. When we really started to look into it, that it was actually much more core plus risk, and they were highly correlated to the market because they had airports, they have ports, they had toll roads, a lot of these type of assets which had a lot of volume risk, and that also have become an issue in COVID-19 world, so to say. So therefore, I think it's important that when we seek for core risk, we want it to be this typical, what you see as infrastructure being long-term cash flows, very stable, maybe regulated or contracted, where a very credit-worthy tenant, maybe be triple B and over, at least being on the investment grade side. And when we looked into the sort of the value add sector, we're looking for the top tier with a good track record. There is a lot of managers out there, given that it's a quite recent asset class or newly asset class. Not so many have track records. They might have done separate accounts and they might succeed in those, but you really have to find someone that could handle a situation like this, and we should be a long-term partner. And I think that's very tricky for us, and this is something that we have to think of when we're doing sort of the risk versus the return. We don't want to go for the managers that are showing the best returns when we know that the risk, given how the cash flow is developing, is also very high.
And in your case, I guess you do a lot of private structures, but overall in the portfolio, do you also run external funds?
You mean if we run external funds for...
If you invest in external funds on the equity side, for example.
We do invest in funds, yes. That is one of our major strategies, prime strategies, had to say, when we're starting off the infrastructure portfolio, given that we don't have a portfolio per now. So if we're adding a wind farm in Sweden or an offshore park or whatever it can be, we're highly we have a lot of risk to that. And if something happens with a project, we're very highly exposed. So for us, when we're starting off building a portfolio, it's very important that we do it with global managers, or at least European managers, which has diversified sectors. So they may be investing in these wind farms or offshore parks, but then they're also in the district heating business or fiber or so on. We really have to focus on the diversity at this stage. Then we want to focus on managers where we can do co-investments with. Since we are a very large pension fund, then we do large tickets when we invest. We also need to focus a lot on the cost efficiency, and to do that is to also do co-investments with our partners. And then we can also do more sort of targeted strategies, which we find interesting at the moment. I mean, for example, telecom, for obvious reasons, is a very interesting sector, and sector that we're looking for.
I wanted to touch on the subject of sustainability as well, because I know that you've done quite a lot of work on that side. How do you look upon that, and how do you incorporate that into your investments?
ESG is of course very important to us, and it was very important when we started off investing in real estate, but even so more important when we're focusing on infrastructure, given that it's a lot of assets which are not as clean as other assets, so to say, and you're focusing on the energy sector and the power sector. So ESG is of course very important to us. So how we have an ESG team internally, which are with us when we're doing the due diligence process. So they're looking into both the investment process and the asset management process. So it's important for us that all the managers and our partners they're investing in, that they're not just only focusing on ESG when they're doing the investments, they're also focusing on it long term and when they're owning the assets. So we have at Alecta we have some prohibited investments criteria, which we can't do, which is, for example, coal, and where we can't invest in companies which are having at least 10% from extraction or 30% from generation of coal. We're focusing on jurisdiction, so we can't invest in something that is on the blacklist. So, for example, now when Cayman came on board on the blacklist, we had some investments that we were looking into where we had some Cayman's infrastructure where we basically or simply just had to back off from, because we can't support that. And I think that's really also important to say. So we're focusing on these investment criteria, and that is also that we also want them to focus on the Paris Agreement. We also want them to focus on CHG reporting. That's really important to us because we have agreed to this net zero alliance, and therefore in 2050 we have to be net zero neutral, and therefore we also need to make sure that the investments that we're doing also are reporting on these things, so we can make sure that we can meet our goals. And we have had quite a tough time, to be honest with you, incorporating this prohibited investments. It hasn't been easy. Some funds are they come far in this, and some funds hasn't, and therefore when we're doing this, we really feel that we can add value, and we also feel that or seen that we have to actually exclude some investments that we thought we wanted to do, because we can't see that our relationship and working together will work for the future, because they can't commit to this. So it's very important for us.
But it has had a real impact on your overall asset management.
Yes, it definitely has, and it will for the future. I mean, it's this whole transition. It's so important for us. So we also need to contribute to it, and I think everyone knows that excluding coal, it's something that is just the first step to do it, and then next steps will be the rest of the fossil fuel. But we also need part of this fossil fuel, the more cleaner ones, to do the transition. But we want to be part of that, and it's really important to us.
What other challenges would you say are existent in the portfolio today? You mentioned high valuations in equities. You mentioned sustainability being a bit difficult to incorporate. What else do you see going forward as major challenges?
I think that dry powder it's a main challenge. I mean, there's a lot of pension funds like us that wants to come into infrastructure. So that's a big challenge, and we have, it's a big challenge because it drives pricing, but it's also a challenge because people really so want to come into the sector that we also see when we're negotiating agreements and we're really trying to make a stand that it might be that pension funds over the world, they just so much want to come into the sector that they're basically approving everything. And they haven't really thought about some ESG criteria, for example. So dry powder is a big risk for us. And then we also have the J-curve effect, investing in infrastructure. We're doing the investment today, but it takes us about 6 to 12 months to be allocated. And there's always a risk. What is the pricing going to be at that point? And then also, as I mentioned earlier, we have a lot of managers out there with, it looks like they have strong track record, but it might just be for a few years. And we know it has been a really good market for infrastructure. So selecting the ones that also can perform in a downturn, that's really tricky for us. And it's a lot of hard work selecting those managers that we feel can do that. And then also to have a well-diversified portfolio so early in this early stage, to make sure that we're not having that we're not allocated to one sector or one geography this early on, and that is a puzzle for me, because I see so many interesting managers, so many interesting investments, co-investments, and so on. But it might be that the stage that we are in, to make sure that we are well diversified, to make sure that we creating a cash yield and so on, that we might have to say no at that point, just because of those reasons. So that's also tricky.
And in terms of geographies, do you exclude some geographies? Looking at emerging markets, for example, is that something that you haven't done yet, or you are going to do?
In real estate, we haven't done emerging markets. We're not focusing on Asia. We have a small minority in some emerging markets, but that's really minor. On the infrastructure side, it's a much more global world, and the funds are more global. So it's much more difficult to exclude emerging markets and in some countries. But we will focus on more sort of European strategies and North American strategies. But we don't have a problem if a minority part of the fund can be in other countries, which are non-OECD. But it has to be a minority, and we have to have in the agreement the certain percentage that we can do. And then, of course, Australia is also something that we will want to have a look into.
And if we look ahead, say for the next 10 years, what do you foresee happening to the portfolio as it stands today, apart from just allocating more into alternatives and infrastructure?
I think we will focus much more on ESG. We just started that journey, and I think as the market develops and it's getting more and more pressure to be more green. Taxonomy is just one thing. I think we will focus much more on ESG and continue that journey. And we will see some managers then we might be able to invest in today that we can't invest in the future, for example. So we will really want to focus on that journey, and we see that as a pension fund that's our role, and it's something that we need to do for the future and for the next generation. And then I think we will also be much more agile. It will be a much more flat organization. We are a global investor, so we need to travel a lot. We need to be out there, and we need to meet our managers and funds and partners. So that also comes with working more agile. And also working much more digital. I think we all learned from COVID-19 that do you really have to fly every time you're going to have a meeting or a DD session? Maybe you don't. So I think you can put them all sort of together into one meeting and then maybe fly. But I think that will increase much more. And for myself, it feels also very good, of course, because of pollution and focusing on ESG. So we will work much more digital. And I think we will also automate a lot of things and effectivize things to also with our balance sheet, we have to, and looking at how many people we are working in the team, we have to be much more automated and efficient. And then I think we will focus on doing things we're good at and do less of the things that we're not good at. I think we will focus on more niche managers that are really good in certain sectors and geographies. I think now when the market develops, also in the infrastructure side, we have started to see some managers coming out being sort of focusing on telecom, for example. I think we will see that also in the infrastructure space. We're seeing it in the real estate space, because if you're going to compete and be the best manager, you have to be focused on one sector, and I think the whole house needs to be that. So I think we will focus more on that, and then also focus even much more, as I already mentioned, about the non-GDP driven strategies. We have the GDP driven strategies and the correlation in our equities portfolio, and we don't need that we need it to an extent, but I think we want the real assets portfolio to complement the equities portfolio and deliver through periods and cycles.
Johanna, thank you very much for taking the time.
Thank you so much.